Thanks everybody for coming today. My name is Mike Cavanaugh. I am with a company called Regiment. We are in Chicago. We are a digital investment bank and a private hedge fund family. We find deals, we allocate to them, and then we kick it over to our digital investment platform to syndicate other investors alongside of us. Um, we're so happy and excited about this partnership that we're forming with Rocket Dollar in this educational um, premise. This is, I think, the fourth webinar that we've been doing, one a month. And really, what's come out of this for us has been great conversations with Rocket Dollar account holders calling up and asking about the deals that we're looking at, um, and signing up through the Regiment platform for access to it. So, um, excited that we had over 130 people sign up today. And today's topic is investing in private markets. We've done real estate, we've done cryptocurrency. Today, we're going to talk about hedge funds and some ideas of how you can invest in hedge funds. Um, Before I jump into the nitty gritty, our lawyers love it when we cover disclosures and disclaimers. I am not giving financial advice today. This is purely educational. You need to do your own research. This is not meant to give any tax or legal advice or investment advice. Everybody loves reading this. If you get through it, let me know what you think of our disclosures and disclaimers. The layout for today is I'm just going to give you a little background on myself. Um, we're going to cover a couple different ways to invest in hedge funds, and we'll break down an investment in a hedge fund. And there's probably going to be some background noise as my entire family is sitting behind me watching this webinar with us. So you might hear some background noise as we've got three different people being homeschooled and a couple of different businesses being run off of my dining room table at the current moment. But my background, just to give you a high level overview, I started in the capital markets industry as a floor trader in the Chicago Board of Trade. I traded the 30-year treasury note or treasury bonds, and I traded in the grain room as well, primarily in the wheat and oat pits. Um, when I left the floor in '02, I started an institutional trade desk and asset management company. It was called Know Your Options, where we did asset management and we were also stock and options brokers. I did that from 2002 to 2012. Just a lot of background noise, I'm sorry. Until 2012, and merged Know Your Options into RCM. And RCM is a financial service company in Chicago. And recently, in March of 2020, launched Regiment, which I've already covered, the digital investment bank and fund family. So I've got experience in investing in all different types of hedge funds, representing them, raising money for them, as well as helping them structure. So today's chat will be pretty fun for me to recap some highlights in the past. So ways to invest in hedge funds. A lot of people always look at like writing a check is the best way to do it. Well, there's a couple of different styles of hedge funds. Um, I always take the should I build it, buy it, or rent it mentality. So that's kind of how we're going to cover the world of hedge funds today. Building it would be starting your own. Buying it would be directly investing into a fund, and then leasing it. The idea of a fund of funds, like where you basically syndicate investments through the different types of hedge funds from a fund of funds that invests in all different types and styles. So those are the three areas we're going to be covering today. So starting your own hedge fund, it's becoming more and more cost effective and possible to start your own hedge fund from a legal and cost perspective of starting your hedge fund. Um, you're definitely going to want to find the right vendors that can help you establish all the different term sheets you're going to need, the private placement memorandums, the different legalities, and the different um, nuances of a Reg D or even a Reg A or um, Reg A plus type of accreditation levels. But um, we just started a fund. It took about 3 months to get going with the attorneys, the accountants, admin, audit, tax. Like you need all the vendors, preparation. It took about, like I said, 3 months. It cost about $50,000 between the legal expenses and the admin, audit, tax, like all the different vendors that you'd have to hire. Before you do that, what you really want to do is determine if you have a subject matter expertise or if you can add alpha through any kind of differentiator or edge. So the same thing that you kind of want to be evaluating hedge funds that you invest in, can you provide that to potential investors? And how well are you going to communicate that story to potential investors? I will say the hardest part of starting your own hedge fund is capital raising. Nobody wants to invest in a first time manager in any capacity. So telling your story and being able to differentiate from other hedge funds, because it's a fairly populated space. Financial services is hugely fragmented. A lot of the nature of our business in financial services and hedge funds is built on trust. So having people that trust you, obviously, that's where you'd want to start in the capital raising process with your own hedge fund. Um, but it's still the most difficult thing as a first time manager. If anybody is interested in starting their own hedge fund, I'm happy to help you in any way I can, steer you in the right direction. And we're looking for a couple of partners as well to stand up a couple of funds within the Regiment family of funds as well. So if anybody's interested in the Start Your Own Fund, um, this is a high level overview, but we're happy to chat because we're looking for some subject matter expertise in a couple different areas. So feel free to reach out on that. Um, so that kind of gives you an overview of, I mean, a high level overview. I don't want to get into the nitty gritty and into the weeds of like who to use or the different exemptions in different states, but there are companies out there that help you with all of that. If you're interested in starting your own fund, I'm happy to dig deeper into that. So that would be the build it on your own investment into hedge fund. When we started our venture capital fund, which is a hedge fund, it's just called a venture capital fund, but it's the same structure, GP LP structure as a hedge fund. What we really drilled down was my subject matter expertise within the fintech marketplace. Having been in fintech for over 20 plus years, we essentially established our first hedge fund, which is called Regiment Alpha, around that subject matter expertise. I didn't have a track record. So what we did is we found a GP, somebody on our team that joined our team and also put money into the fund that had a track record in specifically in fintech VC. So we kind of rented that track record, and I would have had a very difficult time raising any money whatsoever had I not done that. So we were lucky to be able to find a general partner that had a portable track record in fintech, and it made it a lot easier for us to be that first time manager and still be able to take down some checks. Our operational support bench is um, filled with lawyers, accountants, advisors that have each at least 5 to 10 years of experience in the venture capital world. And the asset management piece of it, all of us have been in the fintech space for 20 plus years. So we've got a great team, a great bench. We built that starting in March of this year. So it's not impossible to start your own. And if you are interested, like I said, just shoot me a note and I'm happy to chat with you about that. Um, Direct investment. So the hardest part about direct investment is actually finding and sourcing the hedge funds. Hedge funds typically have not been allowed to advertise. So how do you know what you don't know what you don't know? So it's really hard to come across hedge fund investments. A lot of people just hear through different networks. A friend of a friend, hey, my buddy has a hedge fund. I'm invested in him. You should take a look at it. But the rules have been loosening up as far as what hedge funds are allowed to advertise. There's different types of exemptions around the types of funds that there are. One is called a 506B, Reg D 506B exemption, and one is called a Reg D 506C. The 506Cs are allowed to publicly at least show a name and a type of fund. They're not allowed to show all the intricacies of the hedge fund, but a 506c fund, you're starting to see more connectivity in the advertising space. But once you come across a hedge fund that you like, due diligence is always the top priority. Um, and due diligence is interesting because there's a standard format for due diligence. There's a couple of different organizations. One is called Kaya, which is the Alternative Investment Agency or Administration, the Certified Alternative Investment Administration or Agency. I can't remember one of the other, if it's agency or admin, but Kaya is a group that has a standardized format for investment professionals to do due diligence on hedge funds. I would recommend if people are investing their own money in hedge funds that you get your hands on a copy of that. I've got a couple of different due diligence forms that I'm happy to share with people. Um, if you're interested in seeing what professional investment managers um, use to do due diligence on hedge funds. The importance for the due diligence is um, it's never to ask questions because you're curious. There's no black and white in due diligence. There's the right answer or the wrong answer. And when you do enough due diligence on hedge funds, you find out that you're not asking the questions because you don't know the answers. Like you know the right answers to every question. Do you have an auditor? If the answer is no, then we can't hire you. If they're like, kind of, that's a no. They have to just write down the name of the auditor, right? That's all they have to do. And once you go through a bunch of different due diligence checklists, you learn that there's no gray area in due diligence. There's a right answer and a wrong answer. The wrong answer sets off a red flag and makes an investment not interesting or non-investable. The right answer is just there to cover your butt as an investment professional, or if you're investing yourself into these funds, it's there to provide you with the fact that you did all of the due diligence. And if anything were to go wrong from this, then it's just pure fraud. And the SEC does a good job in taking care of fraudulent actors in the investment space. Maybe sometimes more reactionary than proactive, but they still do a pretty good job of cracking down on fraud. Um, so the other things you want to ask yourself about direct investment in hedge funds um, are the manager's experience. You know, is this somebody that's been a fiduciary managing people's money in the past? What's their track record look like? What are the minimums? A lot of times, the larger a hedge fund, the longer they've been around, they don't want to deal with as many investors, so they'll put the investment minimums to a higher level. Like the Brevin Knight is a big hedge fund that's been around for a long time. I think their minimum's $10 million. Like that's, something that I'm not going to participate in because I don't have $10 million in liquid um, investments to put in a hedge fund. And even if I did, like I wouldn't put all $10 million into one hedge fund. So investment minimums are something to consider as well. Lockup periods, hedge funds are opaque, meaning you don't get to log into an account and look at your uptick and downtick like a Charles Schwab or Robinhood account. You're not going to see anything. You have to basically live on the updates that come from the custodian or the investment management, the hedge fund management team itself. And, you typically cannot see any of the holdings. You have to rely on the updates and the K1 statements that come at the end of the year. The other thing you want to look at are the fees. A standard hedge fund is 2 and 20. There has been some fee compression over the years, and you see some different types of deals. A lot of hedge funds, if you catch them early, they're willing to make deals with their early entrants to give them, more lower fees to start when there's new hedge funds starting up. They tend to give you a better deal. So catching them early is good, and finding them. There's tons of portals coming out. Almost it seems like every day there's like a new launch of some type of investment portal that's sharing deals. I always tell people that they should talk to their like registered investment advisor or wealth advisor if they're interested in investing in hedge fund. A lot of times, the more proactive advisors will have access to the different types of hedge funds. They might even have relationships with companies that offer hedge fund through like different types of platforms or portals. So Direct investment right now, and this is high level, and again, do your own research. It isn't investment advice, but um, there's a lot of money in cash right now, and with the stock market looking to have increased volatility, and most people having enough allocations to stocks, and there's a global yield void right now, meaning you really can't get interest anywhere. The interest rates on treasury bonds are zero just about everywhere. And the stuff where you are getting paid interest, a lot of cases you're taking on way more risk than what the interest rate you're getting paid is worth taking on. So we see a lot of money going into alternatives. And what we like about hedge funds is if you pick the right manager, you can get exposure to capital markets like the stock market or bond market, but you're also getting active management. So one of the things that we believe in at Regiment right now is that, from the last crisis, passive management became very active, if that's no pun intended, that there was a rise in passive management after the financial crisis in 2008. We think there's going to be a rise in active management, and there's going to be an increase in hedge fund activity because arguably the best active managers start their own hedge funds. So we're looking through hedge funds all the time. We're in the process of setting up another fund at Regiment called Regiment Bravo. That name may be subject to change, but it's our second fund. The first one was Alpha, so we just thought Bravo would come next, but we may need to rename it. But our next fund is going to be a fund of funds that allocates to emerging managers. So we'll be scouring through and looking at emerging managers in just about every asset class. We've got a couple of really cool um, hedge funds on our platform right now. One of them trades um, peer-to-peer bonds. It's called Edge Focus. If you're interested in that, just go to the website and check it out. And we're happy to put you in touch with one of our Series 7 registered reps to talk about the nuances of that deal if you're interested. But we'll be scouring through more and more funds with our fund of funds that allocates to the emerging managers. So please stay in touch with us and come back to the Regiment site every once in a while to check out the deals that are floating around on our website. So and if anybody's interested in getting a due diligence questionnaire from us, we're happy to send it out. They're pretty intense sheets, and it's really good to go through with a hedge fund manager because it's the only way that you should invest in a private investment because you're handing your money over to somebody else, and you're not going to see it for a little while because there's lockup periods, and it doesn't have a personal login. There's no account. Hedge funds don't have the technology where you just log in and see your account in real time. All right. That brings us to the third, the fund of funds. Like I said just now, we're at Regiment starting our own fund of funds. Um, when you invest in a fund of funds, you still have to do the same level of due diligence that you would for an individual, like asset manager hedge fund. So you're still going to want to go through the same checklist with a fund of funds and that you would for a regular hedge fund. Um, the other thing you have to understand with the fund of funds is that you're going to have double fees, meaning the hedge fund of funds will charge like let's say 1 and 5 or 50 basis points and 5%, and then they're going to invest in hedge funds that are charging 2 and 20 or 1 and 15. So it's always good to point out that fund of funds, you're paying them to do the due diligence and to have a thesis that you can test on all the things that they're going to invest in, but you're going to get charged double fees for that. So you want to make sure that they are actually doing all of the things that they're going to do. I'm not saying that it's not worth the double fees. If they're doing the due diligence before they invest in all of the different hedge funds, then it's absolutely worth it because you don't have to do it. You're saving money, time. You're saving your time money. You won't have to do it. I already mentioned Regiment Bravo. One thing that I say about ongoing manager updates is you want to make sure that you're constantly contacting the hedge fund manager. A lot of hedge fund managers don't like connectivity with what they'll call like retail investors. They don't want to have a conversation. They want to focus on generating alpha with what they're doing. So a fund of funds, one of the advantages is they're more institutional. They do have ongoing updates monthly with managers. So like the company I mentioned before, Edge Focus, we get a monthly tear sheet from them, and one of our reps has a monthly call with them. So we spend time with them saying, hey, tell us what happened last month. Tell us what you think is going to happen this month. Tell us what you think is going to happen next quarter. What's outlier risk? What is outlier upside? And we have those kind of conversations to just get into a stream of just consistency and clarity with those managers. And we're essentially just looking for red flags, like what's different? Like, why are they going to change the strategy? Did they not change the strategy? The different nuances, and then trying to figure out um, if the strategy is still sound moving forward. So it's always an ongoing. It's not a set it and forget it where you make an allocation to a fund or a fund of funds, and then you're like, all right, we did it. We're invested for the rest of our lives in this fund. You want to stay on top of it and look for nuances of change or, different things. I've always different things that might signal red flags. I've always thought of hedge funds and like mutual funds as airplanes. To draw an analogy, a hedge fund is like an F-16 jet flown by an Air Force pilot that's going to get you from Chicago to LA in 2 hours, where a commercial 747 United Airlines, it's still going to get you from O'Hare to LAX. It's just going to take longer. It's going to cost a heck of a lot less to fly the commercial liner. It's going to cost if you were able to get an F-16 pilot to fly in its jet, that would cost you a lot more than flying in a commercial airliner. So there's definitely value in good funds and good fund managers. What I always tell people is, if you're comfortable with the illiquid, opaque nature of it, and you find somebody that you believe has a good record, or if a friend refers you to them, or if your advisor refers you to them, I always say you want to stay on top of it monthly. Read all the stuff that you get, because hedge funds, in my opinion, they lose their edge or their alpha generating ability in a 7-year time period. Some lose it quicker, but I've always used 7 years as a guideline to short-term alpha generation and active management. It's hard to, as a human being, it's very hard to continually generate alpha in a hedge fund environment for more than 7 years. It's hard to do it every day, but to do it every day for 7 years, it takes a toll on people. Um, there's a lot of algorithmic hedge funds now, so it's not as prevalent. So some people might be able to pull it off, but I still think there's too many market players for people to generate alpha for more than 7 years. So I always try to look at time frames when you're looking at hedge funds to help you, set your expectations as far as how long you want to be in it. Another tip I give people is when you're getting into hedge funds, you want to basically talk to an investment professional to see how much of your liquid net worth should be allocated to illiquid investments. Some people use the guidelines in between 10 to 20%. So if it was 10 to 20%, let's say that's $1 million of your liquid net worth. You're worth 10 million bucks. You can put $1 million into hedge funds. Um, a fund of funds would allow you to diversify that million across all the different hedge funds that they diversify through. Um, if you're interested in direct investment to hedge funds and you're going to keep the ongoing relationship with the hedge fund managers that you're going to touch base with to make sure that they're staying within the framework of their strategy each month. One thing we like to do is watch a manager by making a small investment to start, maybe 50, 25 if the minimums are low enough to allow that. And then while we're talking with those managers, we'll say, hey, look, this allocation went to this. You said this was going to happen this month. What happened? What's going to happen next month? And we get to know them a little bit to track the consistency of the investment to make sure they're doing what they say they were going to do. And you start building comfort with the manager that way. And then you start legging into a larger investment over time. So if you had $1 million in liquid net worth and you put it into one hedge fund all at once and it craps out, it kind of wouldn't have happened had you just put in a little and monitored the consistency. So that's another thing that we like to do when allocating to hedge funds. Not have a hunch, bet a bunch, but start small and monitor the consistency. Some other considerations within the hedge fund world is what percentage of your portfolio. I kind of just covered that a little bit with, most financial advisors would say 10 to 20% of your net worth, your liquid net worth or your investment portfolio. We're starting to see a trend that there's a lot of money in cash right now, and with people looking at bonds and stocks is not as attractive for that cash. We're seeing a lot more active managers in traditional asset classes like the stock market um, that are popping up as emerging managers that I almost call it like a synthetic portfolio. They're taking it away from like the publicly traded stock financial advisors, and they're moving money to these private hedge funds that have more skills in the active management. You see it the higher net worth, like in the family office institutional areas, more so than in the retail investment or mass affluent market. But um, there's definitely a lot of emerging managers popping up that are into active management of traditional assets like the stock market. Um, how to source investment projects, that might be the most difficult part because of just the um, cloak and dagger kind of representation of the hedge fund industry. It's a very private market. Um, but it has been opening up in the last several years. There's been some regulatory changes from the SEC and FINRA that have loosened up accreditation. They've made it more feasible to do crowdfunding. So there are platforms popping up. It feels like daily there's like a Reg CF or a Reg A Plus platform popping up that are starting to list more and more of these projects. There's a couple institutional databases that allow um, access to see some of the different types of hedge funds. And the sell side, like brokerages, have access to um, different things, but different hedge funds. You should always talk to your financial advisor. But a Google search for hedge funds, you'll be able to locate some databases. I'm happy to point some people in directions. If you shoot me an email or give me a call, I'm happy to answer any questions about how to source the investment projects. Um, just a blatant plug as well. We list some hedge funds on our site at Regiment as well. So you feel free to stop by our site to look at any of the hedge fund deals that we've got listed on our site. Um, so as far as investing directly, which hedge funds to buy, what percentage of your overall portfolio, um, what I kind of wanted to touch on was kind of like a simulated 60-40. So most people are familiar with the Markowitz style of investment, 60-40, 60% allocated to stocks. It's called modern portfolio theory, 40% in bonds, and just set it and forget it. Well, that's gone up and down and under debate over the however many past years with all the volatility, whether you're in your accumulation or distribution phase of your investment life. There's a whole bunch of different things. But if you take 60-40 and you look at your money that's in cash and you say, I want to basically find hedge funds where 60% of them would be in a traditional stock market investment and 40% of them would be in a more traditional bond market investment. And you source deals where, let's say you had $1 million that you wanted to invest in a simulated hedge fund portfolio, a simulated modern portfolio theory, but only using hedge funds to get access to those investment classes. So you would put $600,000 into hedge funds that were active managers in the stock market and $400,000 into active managers in bond-like markets. That's just one very simplified portfolio. There's a whole bunch of math you can do to calculate the different nuances of how to establish a simulated portfolio. But that's what I meant by simulated 60-40 is to find active managers in the stock space for the 60% and active managers in the bond space for the 40%. And you'll get some different ways to put portfolios together there. Again, I'll sound like a broken record on this, but investing in the fund of funds, always talk to your investment advisor about this stuff. If you don't like the answer they get from your financial advisor, um, I'm happy to connect people. I've got a large network of financial advisors. I'm happy to put people in touch with good financial advisors that give the right answers. I've always thought that when a client calls an advisor and says, "Hey, I'm interested in looking at some hedge funds. What do you have?" If the advisor says something like, "Oh, hedge funds are too risky. My uncle lost all his money putting money in a hedge fund." Like, if you get an answer where there's pushback from the financial advisor, that's usually a good sign that they're worried about not making money because you would move money away from them, because most financial advisors don't get paid on a hedge fund if you invest. The big wirehouse guys generally do if it's on their platform. So you shouldn't get pushback from most financial advisors. If you do, um, I really think it's the job of the financial advisor to serve you, to basically look into the hedge funds, to read the PPM with you, to explore the different types of risks that are involved with the hedge fund and make sure it's suitable for you. So always talk to your registered investment advisor. If they push back, find a registered investment advisor that doesn't push back and is willing to look at the nuances of the hedge funds that you're looking to invest in. All right. And then just real quick on the due diligence process for investing in funds. First question I always lead with is, how do you as a hedge fund manager differentiate yourself from other hedge fund managers to generate alpha for your investors? And I'm going a little bit over my time, so I want to hand it over to Brendan. But again, reach out to us if you have any questions whatsoever, and happy to share the DDQ with whoever requests it. There's a little bit more about Regiment. If you use the promo code Rangers or Regiment at the Rocket Dollar site, we'll pay 50 or 60 bucks. What you'll get a discount on.
50 bucks off discount.
There you go. And
yeah.
With that, I'm going to turn it over to you, Brendan. Thank you guys for coming today. Thanks for the opportunity for this wonderful partnership, and happy to chat anytime.
Yeah, and Mike, usually we do questions to the end, but this one's really relevant to what you're just talking about. We just talked a little bit about crypto at the beginning. So Caitlin was asking, how would you evaluate a crypto hedge fund and some of that management differently than a hedge fund investing in more non-crypto or traditional assets?
Yeah, Caitlin, great question. So the main nuance in doing due diligence and evaluating a crypto fund versus an asset management fund, it's exactly the same on all like the deep dive except for the tech piece, right? So we'll bring in like the tax, audit, accounting, background checks, like all the different theses, like everything that will ask a regular hedge fund, let's say in the stock market, like a active manager doing a long short global macro. We're going to evaluate the exact same as a crypto fund, except for the nuance. Once we're done with the exact same type of due diligence, we're going to send in one of our crypto experts, like a technical expert, to make sure that their cybersecurity checks out, like that all the tech. It's going to be a more technical deep dive to check on their blockchain usage or non-usage. Are they running, are they running rigs? Are they mining? Are they running nodes? Like, what are the different things technology wise? The super technical stuff is how we're going to do a crypto fund versus a stock fund. The stock fund isn't going to need a technical deep dive. However, I will say in a stock fund that's running algos, we'll have the same type of technical expert go in to make sure that their algos in the black box, we have to see it or we won't invest. If they won't open the box and show us the algos, we won't invest. Sometimes hedge funds won't open the box and show you the algos because they don't want you replicating it. Obviously, if we replicated somebody's strategy, we wouldn't be really good at our job or in business very long because we'd gain a reputation of being pirates, and that's not what we're interested in. But holding on to those different types of strategies is important to the hedge funds, and we respect that. So when we do our technical deep dives, we're obviously under NDA, but that's the main difference between a traditional hedge fund and a crypto hedge fund is there's a lot more of a technical deep dive that we do with one of our subject matter experts.
Okay. All right. Thanks, Mike. We'll probably hold all other questions to the end, but you have any, feel free to do it. And I'll just do a presentation here on some taxes. Thought it was going to be a good topic. A lot of hedge funds, there's a lot of potential capital gains going on. So just thinking about, hey, what have I invested into this fund with a self-directed IRA? So some of this might be directly related to hedge funds, others just more taxes and self-directed IRA accounts in general. But these questions come up all the time. So myself, I'm just used to live in Chicago here, come from the University of Wisconsin, Badgers like Mike Cavanaugh. I got in conversations with Henry Yoshida down here in Austin. He is a financial advisor here down in Austin, had sold a company honest dollar to Goldman Sachs. It says, hey, we're trying to take on the self-directed industry. Would you be interested in coming down? So I moved to Austin here, and we have 15 people here in Austin with no office currently. We're working from home, but we're quite busy with the market activity, and a lot of alternatives are doing well right now. Okay, so what does Rocket Dollar offer? Again, if you've tuned into other Regiment webinars, you might have seen this stuff already, but I'll just go over it quick. We offer a traditional IRA, Roth IRA, a solo 401k, and a few other products, but everything in our platform is self-directed, which means that it has the ability to not only invest in stocks and bonds, but alternatives. And when it comes to something like hedge funds, we just have a thing like no taxes. Don't be paying taxes in a hedge fund if you don't need to, or if this would really make sense for your retirement portfolio. So again, here's the IRA LLC. I'm also going to go over the solo 401k a little bit as well today. So it's an IRA, a Colorado LLC, and a bank account at our partner bank that understands what a hedge fund investment is. So we would help you establish these three pieces of the puzzle and then get your dollars into a bank account, which kind of functions similarly to a money market fund that you might have at TD Ameritrade or Vanguard. So instead of a money market fund that you're clicking and deploying to different stocks, you are sending a wire to a hedge fund team, to the investor relations with their wire details to send that into their escrow account. So although it's going to a hedge fund that's kind of off platform, I'm going to kind of get in the taxes of an IRA still apply here. And with an IRA LLC, you can enter in a limited amount of investment without having to pay a fee each time, or go through a huge deal review, which is sometimes you've already done all this deal review with your advisor or someone else to vet a hedge fund. Some custodians, if you do a direct investment, we've started offering that too. You have to go to their investment team, and then you have to convince them that this is a manager that knows what they're doing. That get through that entire process, and it's not as much of an advisory review. It's more of a, do we want to hold this investment from this hedge fund team? And it can be frustrating for someone, custodian, to get between that. So the great part about the IRA LLC and what's called checkbook control with that bank account there is that you get to decide what you invest in, and you get to deploy that money as soon as you're ready to sign the paperwork as the manager there. Some people ask, like, well, in an IRA, am I missing out on anything? I'm getting retirement tax benefits from it. Is there anything I'm missing? These questions usually come up first. I'll cover the con first. There's no depreciation. This is popular in real estate, but some types of assets, depreciation is really popular. 1031 exchanges, also popular in real estate funds. Don't think it quite applies to a lot of hedge funds, but it could. So where's the tax efficiency, especially for hedge funds? No capital gains tax. Some of these really heavily traded strategies, they've been moving positions in and out through different markets. You could have to pay short-term capital gains if you're investing in a taxable account. If you're inside of a self-directed IRA, you are totally shielded from those capital gains as long as you're keeping that investment inside an IRA for a long term. All right, so pre-tax, what people think of as a traditional IRA, the most popular bucket in your 401k. What are you paying? You're paying ordinary income tax rates, but not until retirement. So it's kind of in jail until 59 and a half, unless you take that out with 10% penalty. So this is a great way to kind of defer taxes. If you're putting an investment in, yes, hopefully you're making gains here, but you can take it out in retirement at a graduated rate. Required minimum distributions, a lot of lingo, but Basically, if it's in a traditional IRA, you're not paying the taxes right now. You get to defer that till somewhere in your 50s, 60s, 70s, 80s, whenever you want to take that out. Then you're paying. You take out the amount of income from your IRAs that you want to. You pay taxes on just that money. Sometimes older retirees, they're only taking $30,000 out, $30,000 that year. Post-tax and Roth, these accounts are becoming much more popular just with tax rates right now. We've hit probably what are the lowest tax rates since World War II. Politically, we've got an election coming up. We don't know what's going to happen. Generally, you have to think really long-term with this stuff. It's over 20, 30, 40 years maybe for you. Is taxes have been pretty low. So Republican or Democrat, if we're at pretty low tax rates for the last, 80 years here, we could see maybe there might be some pressure to push those back up, close some opportunities off, make it harder to access some of these things. So a lot of people are saying, how can I funnel as much money into Roth accounts right now? And why is that? Because if you put an investment in a Roth account, as long as the account is in there at least 5 years, you are able to pay no taxes on that money. A lot of people keep money in for the long term. Some people like to take Roth money out early, which you can do. You don't always have to wait till 59 and a half. You can take your contributions out early, but if your hedge fund has a really nice gain in 2020, you have to make sure to leave that gain in there until at least 2025. A lot of questions come up. Oh my God, these self-directed IRAs are new. This is so different. Everything's different. What's different? It's almost all the same. Accreditation is the same. Taxation is the same as your stocks and bonds. It's a bit of a different concept. People have gotten so used to this. I buy a stock and bond on Fidelity. It's in my IRA. It's in my 401k. I access the stock market. I sell it. In a self-directed IRA, we're creating kind of a new, different structure for you. You're still buying and selling this hedge fund, but it's still inside the IRA. And I'm kind of going to get into that. It's a tax wrapper that protects your investment. So it's not too different investing in a hedge fund compared to a stocks and bond. With a hedge fund, they might do some accreditation standards. Compliance might be checking, an identity, just who they're investing to, who they're advertising to. Compliance departments at a hedge fund, some of those will be really easygoing. Some will be very, very strict, as Cavanaugh was talking about. The advertising restriction, not much changes just because you're investing with an IRA. They still might come and ask a lot of personal details. And you can't hide behind your IRA to get around accreditation standards. Whatever standards the hedge fund would have for you as an individual person is probably going to pass over to you in a self-directed IRA. This is that concept that I was talking about. If I put a hedge fund inside of a traditional IRA, what's happening to it? Think of it the same as having a stock or bond of Fidelity. Ordinary income tax rates, no capital gains, no short-term capital gains with that hedge fund investment. Same with a Roth. You're going to get that 5-year rule. You can take out the contributions, not the gains, no capital gains tax. So still inside of an IRA, even though it's not as easy on a platform, right on the Rocket Dollar platform. You can't just click on Rocket Dollar and investment. You have to sign paperwork. You have to send a wire, but it's still technically inside the IRA. And here's our solo 401k. So our solo 401k, it is only for self-employed individuals. So someone that owns one business, maybe your spouse also owns a business. If you're on payroll, each other's payroll, you can both contribute to a solo 401k. If you have any employees other than your spouse, full-time employees, you are not able to do this account. However, it is such a powerful account. It's so popular with a lot of our customers these days. Some people have a side gig consulting, their husband's wife's business. Even if it's a small business, they look at the solo K and say, wow, I can make this work. This is really powerful for a lot of my tax advantage investing. So you'll see here, we issue a plan document. It's a retirement trust instead of a LLC that gives us the power to invest in lots of different assets. And will have trust bank accounts, a traditional and a Roth bank account. So think of this like Bozo's bucket. You put your traditional 401k money in the traditional bucket. You put your Roth money, goes into the Roth bucket of a solo 401k. And you can use either of these accounts or both of them together to invest in an investment. And why is this account so powerful? It has much higher contribution limits. Right now, there's a bit of a gap. If you don't have a plan at work and you just have an IRA, you're kind of missing out as far as the contribution. $57,000 at 9.5 times higher than an IRA. That's 3 times higher than an IRA. Can get complex. You can do profit sharing or you can do a match. You can do a company contribution as well. So if you're paying yourself something at that personal business or your spouse's side business, then you can contribute to the company side as well. So think of yourself as a little HR manager, a little CEO here. Instead of 50 employees in a 401k, you might just have one or two, you and your spouse. And that allows you to do traditional, Roth, and after-tax contributions. After-tax is really popular with people who like to do backdoor Roths. There's a maneuver called the mega backdoor Roth. We get so many questions about this every single day, every single week. The mega backdoor Roth is probably one of the most aggressive tax saving strategies, completely sanctioned by the IRS, okay to do. But you can get possibly, much more dollars in there than a simple $6,000 into a Roth account with those after-tax contributions. And a lot of people ask, can I start this for they always ask about 2019, right before tax time. You have to start it before New Year's Eve, before December 31st here in 2020, if you want to do 2020 contributions. A ton of people are going to call next year asking and they miss the boat. And another tax topic about self-directed IRAs, UBIT and UDFI. So this is always one of the most complex topics in a self-directed IRA. People always ask questions about this. And why do we bring up in UBIT, UDFI? So these are retirement accounts, but sometimes the IRS can say, hey, you can't shield every type of tax in these retirement accounts. So sometimes a complex manager strategy, complex leverage that I'll get into, can lead to a UBIT or UDFI. So just a general thought. Not all passive investments, or like if you're going a passive investment in a hedge fund versus trying to create your own, having your IRA be an active investor in this hedge fund, not all passive investments are free from UBIT, but there's a much less risk of UBIT in a passive investment. So this drives a lot of decision-making between self-directed IRAs and solo 401ks. You can get really excited to go into a certain fund. All of a sudden, you talk to the manager and their accountant, you find out that they have UBIT. And all of a sudden, you might need to put the brakes on your account and say, hey, I might invest with a taxable account instead here because that does not have any UBIT. So what is UBIT? I've been using all of these acronyms here. Unrelated business income tax. So there's tax that you're shielding in a retirement account, but the IRS basically said, hey, it's fine to work in your retirement account, but there's a few types of taxes. You can't shield absolutely everything. So get into what exactly they don't like you shielding in there. UDFI. This is one of the biggest possible causes of UBIT. Unrealized debt finance income. It's one of the most common types of UBIT tax. The most common is honestly, it's someone trying to buy a single family property, real estate in their IRA, and they try and get a mortgage or leverage for it. That, getting the more debt or leverage you put in a retirement investment in a self-directed IRA, the more possibility you can get hit with the tax. And it can be pretty complex to figure that out. It's a pretty high tax. It can hit as much as 37%. The 3.7 can be very high, and it's on a tax form called 990T. And this is really complex. Only the hedge fund CPA probably knows what it is. Your CPA may or may not know what that form is. So if you go to a hedge fund and they have really complex leverage, they're using leverage all the time with all their investments. It could be a good question to ask, hey, is this going to spit off UBIT or UDFI? you have a self-directed IRA investor? Have they done the 990T form? What did they spit off last year? And smart funds that really know their stuff had invested with a lot of self-directed IRA investors. They can plan around this. However, if they've been doing this strategy and they are set on this strategy, and it's already spinning off UBIT or UDFI, this can be like turning a cruise ship or breaking a train. It could be a long haul for them to change that in the strategy. So you might just have to say, hey, I'm going to pass in the self-directed IRA investment. I'm going to go in and do cash for this one. I'd love to participate in your next fund if you find a way to be exempt from UBIT and UDFI. And so again, does anything else cause UBIT or UDFI? If you try and put a whole business in a self-directed IRA, you put a lot of different business activity, and that business is not paying taxes elsewhere. The IRS could see, hey, is this an individual investor just working his or her retirement account, or is this entire business being hidden in 5 or 10 different IRA investors? So if you're starting your own fund, or if you're starting an LP, a partnership, you just have to be careful of that. Where's the taxes? Where's the UBIT potentially going to be spit off? And visit a CPA. If you need one, Rocket Dollar can obviously recommend one that has great knowledge in this topic. So how do I avoid UDFI? So UDFI is one of the most common types of UBIT. The self-directed solo 401k, really popular with those leveraged investors and real estate investors that could be hit with leveraged taxes on UDFI. The solo K is totally exempt from UDFI. And people often ask why. Why is the thing? This is such an amazing benefit. I am, in a twice levered fund that was spitting off all this UBIT, and all of a sudden my friend invests with a solo 401k. How do they pay no tax, and I get all this tax in the self-directed IRA? The law says so. This is a patchwork of IRS laws that were left to us, and it has not been rectified. So write to your congressperson and say, hey, would you consider getting rid of UDFI and the self-directed IRA? And maybe a very wonky congressperson would say, hey, I'm going to take on and carry that torch. So passive investing. If you're thinking about being an active investor and you find out that you could be subject to UBIT, see if there's another structure where you could come in as a passive investor. That might find you a way to be totally exempt from this UBIT, keep those taxes somewhere else, or not subject to your self-directed IRA or solo 401k. And again, ask the fund. They're usually the person that should, hopefully know about this topic. We can recommend someone. If you ask someone at Rocket Dollar, if you ask just Regiment itself, you got to go straight to the source of where the fund's coming from, because the fund's accountant is the one that's probably going to have the best knowledge on it, and also invested interest. Hey, this is kind of a hard question to answer. It's going to take some time. It's going to take a little research. It might even take a few billable hours from the accountant. So if you're bringing decent money into a fund, they're going to pay for the accountant. They're going to make sure they get a good answer to your question. If you have someone cursory kind of around the investment, it's a really complex question to just ask offhand. You need to go straight to the source and get that information there. So again, Rocket Dollar, we offer account, just closing things up here, for $360 and $15 a month. We offer a gold account, a premium account for $630 a month. The core will totally serve all.
Looks like we may have lost Brendan there. If anybody has any questions, feel free to type in the chat now. Brendan comes back in.
Yeah. I could hopefully still hear my audio. I might pop back out, but I'm finished up here.
We got you now.
Great. Okay. Dropped out a few times today. So yeah, love it if you could drop any questions in here, the Q&A, the public chat. I'd love to answer them. All right, going once, going twice, going.
No questions.
Okay. All right, and
well, thanks for the time.
Yeah, this recording is going to be available as well. So we'll send this out to anyone in your network that you want to share it with.
Awesome. Thanks for your time, Brendan, to all the attendees. It's been fun talking about hedge funds, and I learned something new about the UBIT stuff. That was good stuff. Thanks, Brendan.
Fun times. Thank you. Thank
Yep.
you, everyone.
Later. Bye.